Hello, my name is Justin Fuller, and I run the Ultimate Stockbrokers portfolio at Morningstar, which takes a cross-section of some very attractive fund managers' holdings against Morningstar's research to create a very best ideas model portfolio. So far, I've been basically focusing my search of managers on mutual fund managers, but I've also had several other managers with very attractive long-term track records on my watch list. One of these managers, Mohnish Pabrai, is with us today to discuss his investment philosophy. He's also recently written a book called Dhandho Investor, which outlines his investment philosophy, which has very many similarities to our approach at Morningstar and my focus in managing this portfolio. Welcome, Mohnish.
Thank you.
Your investment philosophy has a lot of similarities to what we do at Morningstar, with your focus on analyzing economic moats and using a margin of safety when looking at buying businesses. Can you briefly discuss how you came upon the Dhandho investment philosophy and how you incorporate it into managing the Pabrai funds?
I think the framework that I'm using really I got started with that framework when I first heard about Mr. Buffett, and I drilled down on his approach to investing, and then obviously subsequently looked into Graham and as well as Charlie Munger. But one of the things that stood out for me is Mr. Buffett always says, I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. And I came at investing with a previous life as an entrepreneur, and I personally found it very useful to use the framework I used when I was an entrepreneur when I'm making investments. So the Dhandho Investor really is, if you will, expanding that one sentence that Mr. Buffett talked about into a book. The idea was, let's look at a bunch of entrepreneurs. Let's really understand how they went about doing their businesses, growing their businesses, and so on. And let's extract from it a framework that value investors can use. And that's what the book's all about.
A unique insight that I got from the book was how you differentiate between thinking about a risky investment and an uncertain investment. And similar to what Mr. Buffett does in managing the Morningstar Ultimate Stockbrokers portfolio, I look at risk as the risk of a permanent capital loss, the risk of downside risk, whereas uncertainty is different valuation scenarios. How do you contrast risk versus uncertainty in managing your investments?
So anytime you embark on, let's say, starting a new business, right? And let's say Bill Gates starting Microsoft, right? Now, the range of possibilities when he moved to New Mexico and set up Microsoft with Paul Allen, on one end is going bankrupt, and on the other end is becoming the wealthiest human on the planet. Okay, that's the extreme end-to-end ranges, and there's a set of probabilities across those different outcomes he could have had. Of course, he ended up at one extreme end of the range, and
right,
which was great for Bill. But the key issue is that Bill and Paul were very comfortable with that wide range of uncertainty. And the second thing about both of them was they took no risk. He put virtually no capital into Microsoft. So if you don't have capital at risk, your risk is down, and his opportunity cost was low because no one would have paid him $100,000 a year at that time, 2 years out of Harvard and so on. So when you look at investing, you sometimes run into scenarios that are very similar to the situation that Bill Gates and Paul Allen faced, where the risk is extremely low, but the uncertainty is very high. And when you have that situation, there's an opportunity to make a tremendous amount of money because Wall Street hates uncertainty, and it punishes uncertainty the way it punishes high risk. So when you have the combination of low risk and high uncertainty, the odds are very high that the reward can be very good.
Something that I know you've talked about before, and what we at Morningstar believe is a core advantage of our approach to picking stocks, is the ability to have a longer-term time horizon in a very short-term investment world. I know in the past you've kind of described this phenomenon or this ability as a time arbitrage, so to speak. Can you expand upon this a little bit?
Most of Wall Street is fixated on the next quarter or 2 quarters out. In fact, what I've noticed is that sometimes, even when it's very clear that a company will have extremely good prospects or earnings in a year or 2 or 3, the street is not willing, for whatever reason, they're not willing to discount that into the price. And I think Mr. Buffett also alluded to this when he bought Washington Post. He said that, I think he valued the business at about 500 million. It was trading at about 100 odd million. And he said a lot of experts would have told you that it was worth 500 million. But they were also selling the stock at the same time. And the reason is, he said that they felt it was going to go down. And he said they were right. In the short term, it did go down. But in the long run, it got to the 500 million. And that sort of behavior pattern still exists today. Right. It's quite surprising, but they do exist. And so the value investor, the long-term value investor, has another sort of weapon in his arsenal, which is time.
I know that you don't like to talk stocks, especially the ones in your portfolio, very much. But in your book, you also say that both Mr. Buffett and his partner, Mr. Munger, have been really huge role models to you over your investing career. I've also been an admirer of Mr. Buffett and Mr. Munger for several years. And in covering Berkshire, in fact, I believe the stock to be very attractively valued right now. And in many ways, it appears to be a classic Dhandho investment with very low risk and very high upside potential. Can you talk about your investment thesis on Berkshire Hathaway?
Well, Justin, I'm glad to learn that you and I think alike. I do think that Berkshire is undervalued, significantly undervalued, and I think it's like Fort Knox. I think that the downside scenarios of Berkshire are so minuscule that it's like money in the bank. I don't think you have downside, but you have very significant upside. So you can easily get to about $100,000 per share in investments per share in 2 or 3 years. And you can easily apply a 15 multiple to the earnings per share. And again, the earnings might get depressed a little bit if you have a lot of insurance claims and so on. But you can still get to 50 or 1,000 per share in value from that earnings engine. So when you pool those two together, you've got a stock in a couple of years that's worth about 150,000 a share. And the second part of Berkshire is that if you bought Berkshire, let's take the 150,000. Let's say Berkshire were trading today at 150,000. If you bought Berkshire at 150,000 today, you would still earn double-digit returns on that money because of having the greatest capital allocators in the history of mankind at the helm, right?
Yeah, absolutely.
But when you buy it at a discount, and you buy it at a, let's say, 1/3 or 30% discount, then over the next few years, the returns are probably much higher than the 10 to 15% range. So it's one of those no-brainer investments because you've got virtually no downside. You will definitely trounce the S&P and the Dow and so on, and you do it with extremely low risk.
You know, one of the other reasons I've added it to my model portfolio, in addition to you and a lot of other very like-minded investors owning it, is that in a way it's almost like a put option on a market decline. If the market declines, then suddenly Mr. Buffett's able to put all that excess cash available to work in very low-priced investments. So in a way it's almost like a hedge in your portfolio too if the market were to have any type of short-term volatility of sorts.
Heads I win, tails I don't lose much.
Exactly.
In this case, I think tails you don't lose at all.
Finally, it was recently reported that after a few years of bidding, you've won a lunch with Mr. Buffett in New York in the next few months. To give our readers a bit of a sneak peek, what is the first question you hope to ask him, and what do you really hope to learn out of meeting with him for lunch?
I think at the lunch, I'm going with my family, and then a friend of mine, Guy Spear, is coming with his wife. I think from my point of view, I'd like to thank Mr. Buffett for his selfless sharing. And then my questions are really related to a foundation my wife and I recently set up. It's called the Dakshana Foundation. And I think the website is dakshana.org. It's DAKSHANA.org. And so Dakshana is focused on helping very poor but gifted underprivileged kids in India get into elite universities to dramatically enhance their incomes and so on. So I'd like to just get his take on what we're trying to do and whether he has any suggestions or perspectives on that.
Well, that's great. Well, Mohnish, thank you very much for sharing your thoughts on investing with us. And I encourage each of you to check out the Dhandho Investor, as I believe it will help each of you become a much better investor. As a reminder, please also be sure to sign up for my free email alerts of the Ultimate Stock Pickers portfolio to continue to check out our very strong performance, as well as further insights from some of the best investment minds around. Thanks very much.